Hey, what's up everybody? Welcome to part 2 of a 4-part video series I'm putting together to help you manage your finances better. When it comes to wealth creation, it's extremely important that you have a firm grip on your finances. And I hope this video series helps you become much more savvy when it comes to money by giving you some insights in terms of the 4 most common types of debt, namely being unsecured debt, vehicle finance, property finance, and business finance. In part 2 of this series, I'll be chatting to you guys about vehicle finance and the things to consider when buying or upgrading to a new car. Enjoy. So, you find the car that you like. The most important thing that you need to understand about that car is that it's a depreciating asset. In other words, from the moment it leaves the dealership, from the moment you drive out with that car, its value decreases over time. And this is extremely important to understand because when it comes to second-hand cars or demo vehicles, they are significantly much cheaper than new cars because of this depreciating aspect that I'm chatting to you guys about. So this might be an option in terms of buying a vehicle that might be affordable to you as opposed to buying a new vehicle that might be costly because it hasn't yet depreciated. When you're financing a car, the bank will hold the installment sale agreement as security on the deal. Now, cars aren't great security, but they're security nonetheless. And this enables the bank to lend you the money over a longer term. But even though the bank can lend you the money over a longer term, the asset itself is still not a great security. So even though the interest charge might not be as high as unsecured debt, interest charge on car finance is still relatively high. And it's very, very important that you understand this so that you can start managing your finances by paying it off as well as quickly as possible. Just to give you perspective, let's say you find a car and it costs about 200,000 Rand. You approach a bank and the bank does the necessary checks. They look at your profile, they look at your debt levels, they look at your month-to-month income and expenditure to ascertain the serviceability, and then they approve the loan. So they give you 200,000 finance at a rate of, let's say, prime plus 1. Prime at the moment is 10.25, so your effective rate is 11.25. And let's say they agree to finance the car over a 5-year term, so 60 months in terms of monthly payments that you will need to make. Now, on a 200,000 Rand finance at prime plus 1 for 60 months, there's a number of things that you have to understand. 1, to initiate the finance, the bank will also charge you an initiation fee. And this is about 1,197 Rands inclusive of that. At the same time, banks will also charge you a monthly service fee for all the debt facilities that you have in your life, including this car that you're looking to finance. And this is about 68 Rand 40 a month. So all in all, your installments will work out to about 4,500 that you'll be paying every single month for 60 months until the car is effectively paid off. Now, if you do the math and multiply 4,500 by 60, you'll see that it works out to about 268,000 Rand versus the 200,000 Rand that the car costs. So the finance charges and all the interest accumulated over 60 months equates to a premium of 68,000 charged to you for financing the vehicle over to you. If you were to opt for a 6-year term or a 72-month term, then the premium charged to you in terms of finance charges goes up to about 82,500. So it's extremely important to understand that even though the term is longer, all that means is that you're paying interest for longer. And if you extend the term to another year, you're then adding finance charges to yourself, and these can accumulate to quite exorbitant amounts. So if you can afford to pay the car off quicker, rather opt for that than accumulating interest charges unnecessarily. What other people do is also add on residuals or balloon payments that are payable at the end of the term. Now again, it's important to remember that a car is a depreciating asset. So the residual will be calculated on cost, 30% or 40% of the cost price, but it will be payable at the end of the term, and the car would have significantly depreciated. When it comes to financing a vehicle, the most important thing to consider is your long-term wealth aspirations. You don't want most of your cash flow tied up in an asset that is depreciating over time. So when it comes to financing cars, always remember that you're paying interest over the term of the loan on a depreciating asset. So it doesn't make sense financing it longer if you can afford to pay it off quicker. The same is true for a balloon payment or residual. This is calculated on cost, and even though it's payable at the end of the term, you're still paying the 40 or 30% of the cost price on a car that is depreciated significantly in value. So have a long-term perspective. Be clear on how quick you can pay off the loan and try to pay it off as quickly as possible to free up cash flow. And the rule of thumb is this: if you can't afford to pay it off in 60 months and have to extend to 72 months or add a residual of 30 or 40%, it simply means you can't afford the vehicle. So rather opt for something less expensive, or a demo vehicle or a second-hand vehicle. I hope this has been extremely helpful in giving you some insights that you can start looking at when it comes to financing of cars, and gives you the financial literacy to start being more savvy when it comes to your money and how you manage your finances. Be sure to check out part 3 of this 4-part series where I'll be chatting to you guys about property finance. Please check it out. I promise you it's going to be a movie. One love.